Hello, friends. This is Deepak with Tax Code Advisors, and I want to welcome all of you guys who are joining us for today's meeting. So, I think just last week somebody sent me a question and a link to a video. I think it was by Rich Dad Poor Dad guys, and I think the video was talking about how small business owners ended up paying, 60% tax, and individuals pay almost 40% tax, something like that. So you know what? That's not really true. Um, the numbers could be anywhere, right? You can say 30%, you can say 70%, you can say whatever number you want to say. But taxes are so individual. It really depends upon your situation. In matter of fact, most small business owners actually don't pay that much taxes because they have ability to control how they use the income and expenses to, craft a strategy to reduce their taxable income. So I disagree with that all whatsoever. Is there somebody out there who probably got screwed, just doesn't know how to properly structure their income and expenses? Yeah, maybe. But most people, even the people who have bad tax returns, they're not really doing that good of a job taking advantage of various tax strategies. Even they don't really pay that much tax. So please ignore that. That just doesn't make any sense. I think they are in business of selling books and they're in business of selling real estate, and perhaps that's the angle they were making. Maybe it was really more of a marketing stunt than anything else. So no, definitely not. And if you're in doubt, bring your tax return to us and let us analyze it, and we'll see what we can do to help you out there. Okay. So that's the answer on that one. Second thing is, I promise you that I was going to talk a little bit about the basic of wealth building strategy. And the basic of wealth building strategy is to have three buckets. And these three buckets should hold different kind of income in them. So bucket number one should be your business. So if you don't already have that bucket, then you should think about how you can create that bucket. And one of the ways to do that is by joining our small business advisory group. And in this group, we talk about nothing but this bucket. We discuss ideas, how to start a business, how to grow the business, how to market the business, how to operate the business, answer your questions related to that. So that's a bucket you got to have. Now, many of my clients are H1, and if you are on H1, you have a spouse who is on EAD. The spouse can set up that bucket number one. So it's important that you utilize them to set that up and take advantage of various tax strategies that might be available out there. So definitely do that. Okay, bucket number two. Bucket number two is that's where you hold your assets, such as your real estate, your rental properties. That's where you hold all of those assets. Now, if you are on H1 and you don't have that particular bucket, then you should definitely start thinking about creating that bucket. Your H1 is not a hindrance for that particular bucket. You can definitely set up, you can buy a investment property, no problem at all, or residential property for that matter. Okay, so that's your bucket number two. So everybody should utilize it. Matter of fact, the more income you make, and as you get closer to retirement, if you have this assets in this bucket number two, they can be very, very advantageous to you for your overall retirement strategy as well. Why I'm bringing that up? Because a lot of time and by the way, I love small business owners. I love people who are doing side hustles. I love realtors. I love insurance agents. So if please, I don't mean to discredit you guys at all. I mean, I love you guys, and there are great ways, and there's a great need for those products as well. But at the same time, insurance is not the only retirement strategy. There are a lot of great strategies, awesome ways to protect your wealth and build wealth at the same time. And I think real estate is one of the ways to do that. So you just need to learn about it. That's all it takes. So this is bucket number two, extremely important for you guys to save taxes today as well as to save taxes later on. And your third bucket is that's where you hold all your retirement assets, your Roth IRAs, your IRAs, and all that kind of good stuff. And we definitely do have a strategy to maximize that as well. So these are your three buckets. This is my three bucket strategy that I like to use with my clients. So you should definitely consider having these three buckets. And if you don't have them, then you should work on creating those buckets. And then all this money from these three buckets flows down to your living trust, revocable living trust. Now, those of you guys who are new members, revocable living trust is nothing but just a document that defines how do you want all of these assets to be treated? Do you want them to go to a particular beneficiary, or you want them to go to a charity, or you want them to be structured in such a way, who should have authority operate them? So we define all that kind of good stuff in a living trust. And that's an extremely important step, because if you don't have that, then we can have a lot of extra expenses, a lot of extra headache and trouble. Not the end of the world. It can still be dealt with, but it costs a lot of money. So that's why, if possible, we should avoid that. If you don't already have a living trust, definitely reach out to us. We work with attorneys, we work with paralegal. We can even provide you some self-help tools if you want to do it that way. So a lot of different options to create your trust, but definitely at least ask for it if you don't already have one. We definitely will. So when you come to us to do your taxes, or we're doing your tax planning, then we will ask you that. And if you're missing anything, then we'll let you know. Okay, so that's our basic structure for building wealth. So all of you small business owners should have that in place right now. If you don't, definitely talk to us and let us see what we can do to help you out with that. Okay. Having that said, let's move on to our conversation that we were having in our last meeting. And we were talking about LLCs, limited liability companies. And what I said last time was that, look, if you have an LLC, please maintain it properly. And I say this because so many times people walk into an office and they already have an LLC. Few people, we create the LLC for them. They're starting new business, they're buying a new property, maybe there are a couple of partners getting together and they're starting a new business. So we set that up for them. But many of our clients already have one, and they walk into an office to do their taxes. And that's great. We love you guys. Please do continue to come. But problem is that when we start asking questions about the LLCs, oftentimes we get blank faces. They have no idea. Why? Because the LLC was created either online, or it was created by somebody, who just sold them an LLC, and it doesn't have an operating agreement. It doesn't have membership certificates. It doesn't have, it doesn't have any kind of advisory board setup. It doesn't have any kind of minutes. Their domain name is in personal name. Their checking accounts are all messed up. So all sorts of issues we will see with an LLC. And an accountant might not really catch all that, or nor they will ask questions related to that, because their job is to do your taxes, not to maintain your LLC. That's either your job or your attorney's job. But here at Tax Code Advisor, we have a little bit different way of thinking. If we see something, we're going to say something. We want to remind you guys, whether you do it through us or somebody else, that's a different story. But I can tell you, you'll find us to be extremely reasonable compared to somebody else in the market. So because we want to run your business this year, next year, over the years, and then eventually help you pass on your wealth to your kids and to whatever you want to do with that wealth. Okay, so how should these LLC be trusted, and what does it have to do with trust? So rental properties, like I said, this is your bucket number 2. Rental properties should be held in LLC, mostly. Some cases they should not be. So I'm not going to talk about those cases, and that's why it's important to do a consultation. So if there's a reason why it should not be held in LLC, you should know about that. So normally, you will buy a property, and that property will be owned by an LLC, and that LLC is actually owned by your revocable living trust. So that's the structure. It may change depending upon how you're buying the property. Maybe that property is into partnership. Maybe you have a spouse involved. Maybe you don't have a spouse involved, depending upon what state you are in. Or maybe you are a wealthy client. Maybe you have a lot of real estate, and then I need to thinking about charging order protection. I talked a little bit about that in our last meeting. So a lot of other things which I don't want to discuss right now, because that'll just make things a little bit more complicated, should be accounted for. Okay, but that's the key reason. Now, one of the great advantage you have with owning a real estate is something known as a status of being real estate professional for the tax purposes. Now, why do I say for tax purposes? What I mean by that, it is possible that maybe you are a part-time teacher. Okay, maybe you're a part-time teacher, but for the tax purposes, majority of your time is spent on dealing with real estate. If that's the case, then you're a real estate professional. And being a real estate professional, you get a lot of additional benefit, especially if, let's say, if you have a W-2 spouse who is a high income earning person, and then you are a real estate professional and you own a lot of real estate. I think together, that's a great tax saving strategy. Why? A real estate professional can deduct rental property losses against other income without any kind of limitation. Versus non-professionals, meaning regular people, have a deduction limit, which is only $3,000 for most of us, unless you are in a lower tax bracket. Your earnings, I think, is about $150,000 or less. Then you have up to $25,000 that you can write off. But most of us who are over 150K household income, we cannot do that. So what happens is, see, when you own a rental property typically generates what we call paper losses. And this is typically because you have a lot of expenses. Maybe you have to travel to manage the property. The property has depreciation. So all kind of paper losses are generated. So because there are paper losses and you typically don't collect as much rent out of a rental property, the net result is there is a loss. It will be nice if we can take that loss and write it off against our W-2 income. But there are limitations. Like I said, there are limitations on how much you earn. So if your household income is over $150,000, then you can only write off up to $3,000. Everything else gets collected in a sub bucket, so that those losses doesn't go away and they don't disappear or anything like that. They just stay in that bucket until you're ready to do something with that property. Okay, so overall, it's a great strategy. Now, what happens is if you are a real estate professional or your spouse is a real estate professional, then this cap limit doesn't apply to you. So let me give you a hypothetical example. Let's say you're making $1 million a year. I know some of you guys be like, what, $1 million a year? Yes, there are some people who do make $1 million a year and even more. Many of them are our clients. So if you are one of those and you have a spouse, maybe he or she is stay at home spouse, you know, have them become a real estate professional, buy some properties, let them manage it. And if they manage it and qualify for real estate professional, and these properties, let's say, are generating $300,000, $400,000 in losses, you can write that off against your income, against your W-2 income. So I want you to think about that for a second. Let's say you are generating $500,000 in losses. Most of you who are making over 500K or more, there's a good chance you are in 50% tax bracket, especially if you're living in a state that has state tax in it. That means $500,000 of an income is costing you $250,000 in taxes. If your spouse can qualify for real estate profession and you can generate $500,000 in paper losses, you just saved yourself $250,000. And you can do that every single year. So just imagine what a wonderful strategy that is. Now, um, if you remember, there was a lot of talk about this a few years ago, especially when Trump had just recently become a president. And the talk was that Trump only paid $600 in taxes the year before he became the president. But he had a lot of income. His income was like in millions of dollars. How did he get away with that? How did he only pay $600 in taxes when he had millions of dollars? So, and some people hate him for that, and some people absolutely in love with Donald Trump. So even this year, he has a good chance to win the elections again. What happens, nobody knows. But what I want to talk about is really more about this real estate professional status here. You see, Donald Trump was able to legally minimize his tax liability because he qualified as a real estate professional. You can do this too. His real estate investments generated substantial depreciations and other write-offs, which offset his income from other sources, such as, he was doing TV shows, he had retail stores, he has books, So he had multiple revenue stream coming in, but he was able to write off a lot of losses from these properties. Shoot, he had his personal airplane. Every time he goes from one location to another, I'm sure he writes off a lot of that as a business expense. Imagine all that. He's able to write all that off. It's all legal. You can do it too. It's just you got to learn about this and make the strategy work. So do you have to be high net worth individual to do this? Absolutely not. You can start out with a one bedroom condo. You can start out with you know some anything that you can buy in real estate. That can work. I guess the only time it won't be effective is if you just own land, because you cannot depreciate land, right? But there are some other benefits to land as well. But for the most part, majority of the time, this will work. So, do you have to be a realtor to become a real estate professional? I think it will be helpful if you're a realtor. It will be definitely be helpful. But on the other hand, just because you're a realtor doesn't really make you a real estate professional. It is possible that you're a realtor, but you also have a W-2 job, or maybe you are engaged in some other profession. So if you're doing something else full time, then you would not qualify for real estate professional status. So, like I said, by generating depreciation and other write offs from rental properties, you can potentially offset all of your other income, leading to your overall lower tax liability. So, I'll give you another example. So, sometimes my clients, especially the senior clients who are in their late 50s or 60s, I usually recommend them take a look at your real estate portfolio and see if you can actually do a 1031 exchange. And why I say that is because, by the time they're in their 50s and 60s, if they bought their properties in their 30s and 40s, that property has appreciated. And the depreciation works based on the purchase price of that property, not on how much mortgage you have left. So if you do 1031 exchange on that property and get a different property that is now worth more, then you can depreciate more. So that's why it's important to consider those advantages as well. So being a real estate professional can allow you to use losses from rental properties to offset income from other sources. So I hope that point is absolutely clear. And this can significantly reduce your tax bill. So definitely, if you're not already engaged in that, then consider that. But I think it really works very well when one spouse has a W-2 income and the other spouse qualifies for the real estate professional status. Sometime I would see that both spouses are W-2, but one of them is a realtor. That doesn't really work that well. So, what are the requirements to qualify for real estate professional? Well, the qualification includes spending at least 750 hours per year in real estate activities. That could be managing real estate, going to real estate, doing stuff at real estate, marketing real estate, doing accounting for your real estate, anything related to real estate will count as that. And you need to really keep log of those hours as well. So 750 hours, that's the minimum requirement. You can do more, but nothing less. Okay. So very, very important. So this can involve managing personal rentals. You can be a contractor, realtor, broker, but you cannot be a W-2 employee in a related field. So let's say if you are working for a property management company and you're a W-2, you cannot claim yourself as a real estate professional, even though you're actually working in the real estate field. You see, because you're working for somebody else, you're a W-2 employee. Now, if you are getting salary and you have a stake in that company, at least 10%, then you still have a chance of claiming that. Now, as a real estate professional, like I said, there's no cap on the amount of losses from real estate that can be written off against any other income. Now, on the other hand, for non-professionals, as I said earlier, the cap is $25,000, which phases out at higher income levels, but the access can be carried forward by you if you are not able to use that. Um, Oftentimes, people buy a property and then they rehab the property. So, can you deduct that? Yes, but it depends on the nature of the cost. You see, maintenance and repairs are generally immediately deductible. So, if a fan breaks or an AC broke, uh, and you need to get somebody and spend $400-500, no problem. But if you do some sort of improvement, for example, you replace a new water heater or you replace a roof, those kind of items needs to be capitalized and depreciated over time. However, you can use cost segregation. Sometimes you probably hear the word cost seg. That can be used to accelerate your deductions. It's very, very effective for some people, but not necessarily for others. So I think you need to have a tax professional run some numbers and see if that makes sense or if it doesn't make sense. You may ask, okay, so what's the difference in tax treatment for renovation expenses for real estate professional versus non-professionals? Does it make difference? If regular Joe is doing it, what is it they qualify for real estate professionals? Um, so see, for real estate professional, costs that can be highly beneficial as it allows for accelerated depreciation, which can offset income from other sources. But on the other hand, for non-professionals, however, the benefit is limited as the accelerated depreciation merely adds to carry forward bucket and does not offset the current income. So once again, let's go back to that example. Let's say your spouse is making $1 million and you bought yourself a big building in San Francisco that is producing $500,000 in depreciation. But this building also have AC, it has some wiring, it has some microwave, this and that. And maybe you can increase that depreciation from $500,000 to $1 million. Just as an example. If you are a real estate professional, you just wipe off the entire income of your spouse. Your net taxes will be zero. He had $1 million income, you have $1 million expense, you pay zero taxes if you qualify for real estate professional. But if you don't, then remember that $3,000 limit. That means you can only write off $3,000. So does it pay off to be a real estate professional? Absolutely. Absolutely. So it's extremely important to do that. So I hope that answers some of those questions, and I want to take on to this continue on to this conversation in our next meeting. We'll talk a little bit about how short-term rental strategy can play out and some of the other things that you can do with real estate. And those of you guys who join our monthly market outlook meetings, in those meetings we even discuss what is the outlook, what's happening with the interest rate, what's happening with the real estate market. Is there any new information that we can act on? So we talk about all of that. So all of you guys who are in our small business advisory group, you get free access to that meeting as well. So once again, thank you so much, guys, for coming here today. I'm gonna stop it here at this point, and then we'll continue on with your questions for the rest of the meeting. Now, those of you guys who are new, if you have any questions, need some help, just send us a WhatsApp message and we can definitely go back and get you that help you need. Okay. So thank you so much, guys. And I'll open it up for Q&As now. Thank you.